Hello, my fellow investors. I'm doing here a small video update on Thor. I made a whole series on Thor, and this whole video is going to be an analysis on the Thor's acquisition of the Oppenheimer Group. And as I stated already in part 4 of the series, that this acquisition seemed to me to be a stain on Thor's history. In part 3, I laid out the entire history of the acquisitions, and they were very good at it. And even the Tiffin group was, although not so good as the ones they acquired before in the past history, but they were earning money on the Tiffin group. But the Oppenheimer group was looking bad. And I'm going to sum up, it's already almost 4 years since they acquired the Oppenheimer group. It was February 2019. We're closing already 2022. So almost a full 4 years. It should be enough time for a company to get things right and figure it out. But the numbers are looking bad. It's looking, I don't know, very bleak. I'm not doing any judgment. I'm not doing any recommendations. I'm just putting out the facts. So let's get straight to it. So I just wanted to compare what's going on in their company in the United States, what's going on in the Oppenheimer Group in Europe. So I made here in their all the 10Ks and the 10Qs, they have the net revenue for each division by itself. So the net revenue isn't exactly the net revenue. It's first of all before taxes, and second of all, it doesn't have the net revenue like the corporate revenue on top of it, the corporate expenses on top of it. So you have so each segment is by itself, but you have the corporate, which has more expenses. You have the SG&A from the corporate. So the net revenue isn't totally exactly a net revenue before taxes. It's more expenses before that. But just it's a good number to show us the difference between what's going on in the United States and what's going on in Europe. So in 2018, the U.S. net revenue before taxes was $667 million. 403, 408, 861, 1.4 billion, 235. This is the last 10Q of October for 2022. The total in the last since 2018, they earned from the U.S. segment, so it's not net revenue, it's before taxes and before a few other expenses, but $3.3 billion before taxes. And let's compare it now to the Oppenheimer Group. In 2019, they lost, again, this is before taxes, before a lot of other expenses, almost $6 million. In 2020, they earned $9.8 million. In 2021, they earned $160 million. In 2022, they earned $87 million. And as of the last quarter, October 2022, they lost $6.4 million. Total, $201 million. Now, if you look only at these numbers, you say, okay, well, not bad. They bought a company for $2+ billion after 4 years. Okay, not the best numbers, but they're earning money. So actually, it's not true. And why isn't it true? Because Thor didn't have any debt before they acquired Oppenheimer Group. Maybe they had a little bit interest expenses, but they didn't have any debt. And they took on a ton of debt for the acquisition of Oppenheimer Group. And if we want to truly know how much money the company is actually earning from this acquisition, we have to take into consideration how much interest they're paying. Because they wouldn't have been paying this amount of interest if they wouldn't have acquired this company. So let's say in 2018, the interest payment was $5 million. 2019, after the acquisition, was $68 million, $107 million, $94 million, $91 million. This interest is because of the debt they took to acquire the Oppenheimer Group. So we can't just say, okay, they're earning $87 million before taxes. No, because this revenue is before the interest. And it's pretty clear. If you look through the 10Ks and the 10Qs, you'll realize this income is before the interest, because they put the bottom number in the 10Ks of the net revenue before interest, before taxes. They put it with the interest. So the thing is, the way Thor makes all these calculations is they in the segments, they do the net revenue for the US, the net revenue from the Europe segment, and then they do corporate expenses. And in the corporate expenses, they put in the interest. So basically what they do, they take you the net revenue of Europe, of the whole Oppenheimer Group, without the interest. The interest they put inside the corporate expenses. So you're getting actually a false look, because if you really want to know how much money they're earning or losing on the Oppenheimer Group, you have to take into consideration the interest they're paying on this acquisition. So, of course, it's the corporate who's paying the interest, but the corporate is paying the interest because of this acquisition. So that's pretty simple. You can just look into 10Ks, you'll figure it out right away. They put inside, you can see the bottom lines, you can check it out. It's very simple. So we need to actually calculate how much money earning or losing on this acquisition. Another huge thing you have to take into consideration is the currency transactions that they're paying. They're losing a tons of money on transaction of all the currencies that they're taking out. In the bottom line, it doesn't show, but in the comprehensive income, it does show. So I made a calculation how much money the company actually lost on the Oppenheimer Group. And this is just a rough calculation. The true number is high because we can't know exactly how much the expense of the SG&A is in the corporate part because of the Oppenheimer Group, because the company doesn't say how much SG&A they added on because of the acquisition of Oppenheimer Group. So it's pretty hard to know the exact number, but this is the minimum. So again, we said that the total revenue before taxes of the Europe segment was $201 million since they acquired it. Interest. So we're taking besides the $5 million, they paid $388 million in the past 4 years, more or less. And now the currency transaction, how much did they lose in it? They lost $228 million, almost $230 million they lost on currency. And this loss would have never been if they would have stayed in the United States, in Canada, whatever. All this expenses all this losses and expenses because of the Oppenheimer Group. And now another thing you have to point out. And we can say that the interest isn't an exact number because the company also took a loan to acquire the Tiffin Group and Airxcel. So I just want to point this out. They acquired the Tiffin Group in 2020, and they acquired it for $300 million. And they took a loan of $165 million. And the Airxcel, they bought for almost $50 million, and they took a loan of $625 million. So altogether, it comes up to $790 million that they took a loan for these acquisitions. So we could say the part of the interest that they're paying isn't only because of the Oppenheimer Group, it's also because of Tiffin and Airxcel. But it's not true, because if you could take into consideration how much money the company earned from the U.S. segment, they wouldn't have needed to take these loans. So let's say Tiffin, they bought in 2020. In 2020, they earned $408 million before taxes. They earned $408 million from the U.S. segment. Okay, so pretty much with this money, take off taxes, you have more or less all the money you need to buy the Tiffin Group without taking any loan. There's no need to take a loan of $165 million. Okay, maybe take a small little loan, but nothing more than that. And then again, the Airxcel they took a loan for $625 million. They bought this in 2021. Again, they earned in 2021 $861 million only from the U.S. part, without the Europe, only the U.S. before taxes. Okay, again, take off taxes, take off from all different kind of expenses. Okay, so you have a few $100,000, a few $1 million you need to take a loan. Okay, no problem. 2022, they earned $1.4 billion before taxes from the U.S. segment. They would have paid everything back. So they wouldn't, maybe for a year, they would have needed to take a smaller loan to buy these two acquisitions. But the whole loan that they have now, all the debt that they have now is more or less basically all because of the Oppenheimer Group. They could have bought these acquisitions if they wouldn't have not gotten into the problem with Oppenheimer Group. They wouldn't have needed to take any loan to buy Airxcel or Tiffin, maybe even a small bridge loan, nothing more than that. So it's pretty simple to say that all the interest expenses that they're paying is because of the Oppenheimer Group. So again, they earned $201 million before taxes, and that's not the total revenue. The actual revenue is even lower. They lost $388 million. They paid $388 million in interest. They lost another $228.9 million on the currency transactions. And now another thing I want to point out. They put inside all the 10Ks and the 10Qs how much is the total RV US assets. So how much is the company's assets of the RV worth, besides corporate assets. In 2018, they had a total assets of $2.1 billion. And in October 2022, their total U.S. assets was $3.2 billion. So it went up $1.3 billion. Just pointing out that the net asset, the worth of the assets went up in the U.S. segment. But when they bought Oppenheimer Group in 2019, they listed all the assets of the RV in the Oppenheimer Group as $3 billion. And we're here in October 2022, they list all the assets of the Oppenheimer Group as $2.4 billion. So this is another loss of $680 million. Now, it's not actually a loss. It could be a depreciation of assets. It could be amortization of goodwill, whatever it is. But I'm saying the company, besides losing all what they lost on the currency transactions and what they paid for interest, besides all that, their assets of the company that they bought went down at $680 million. So this will all sum up a total loss of $1 billion. What I'm saying is, how much money did they earn? Minus the interest they paid, minus what they lost on the currency transactions, minus deduct all the value of the company that went down, the Oppenheimer Group assets that went down, it sums up to a minimum of $1 billion. Now that does not look good for buying a company for $2.5 billion. After 4 years, you can say the company lost $1 billion. That does not look good at all. And we're not even talking about, so it's not exactly to say that they lost $1 billion, because the taking off the assets is not a loss. It's just depreciation of the value of the assets. So let's take off this number. They lost for sure a minimum of $460 million in the last 4 years on the Oppenheimer Group. That is not a good number at all. And I just want to point out, so they have the total debt as of October 22 is $1.7 billion. And the debt that's due until July 2026 is $1.2 billion. So basically, the company has to earn another $1.2 billion until 2026 to stop paying, to pay back the debt. And just, I'm saying, if we're going into recession, that number doesn't look so very, that's not a happy number to see. That's all I'm saying. Now, I'm not recommending anything. I'm not saying any advice. I'm not putting any judgment out. I'm just putting out the facts the way it is. And as I stated already in the series before, in part 3 and part 4, I said the Oppenheimer Group, to me, looked like a big stain. I understand why they did it, but I think they paid way more than they should have paid for this company. That's my takeaway. I'll continue to watch out to see what's going on. And I just want to finish this video with a video of the great Don Yacktman. He's a great value investor. And there's nothing like learning from the greats and nothing like learning from history. And I think this video of his would be very eye-opening, and we could take into consideration what's going on in Thor. I think it'll be very helpful for investors just to listen to him. So here it is.
But here let's talk about the reinvestment process, because that's what's left over after the dividend is paid. And the management team really has 5 basic options with the money that management or with the management retained money. The first one is to put it back in the business: R&D, marketing, cost reductions, distributions, on and on and on. And trust me, if you have a great business and you can grow units in that business, it's wonderful. The rate of return, the marginal rate of return on new incremental growth is really excellent. And so it's a very important part, and I would never minimize that. The problem is as companies start to get past their infancy, they start to generate excess cash. And usually they can't absorb all the cash that they are generating in their existing business. So they have to start examining 4 other options. We've talked about one of them, which was a dividend, and obviously one of them is just sitting on it. But there are 2 others that they tend to look at too. And the next one is the one that's so difficult, and that is making acquisitions. And too many times, unfortunately, the egos override the economics when acquisitions are made. And I think the classic on this one is if you go and look at a company that's now part of Pepsi, but before that it was Quaker Oats. Bill Smithberg was the CEO of Quaker Oats, and he actually showed both extremes, if you will. The first one is he went and he bought Stokely Van Camp. Now, Stokely Van Camp was in the canned vegetable business. They had some food chemical business, and they also had one little product called Gatorade. Well, what he really wanted was the Gatorade. And eventually, after he bought it, he liquidated the other pieces, and he was left with Gatorade, which was worth billions of dollars by the time Pepsi purchased the company, and has continued to be a very valuable product line for PepsiCo. Then in the 90s, he went out and he bought Snapple. He had attempted to buy it once before and hadn't gotten it, so he paid up this time, paid like $1.5 billion for it, and then realized the distribution was not tied in with the other pieces of the company. It didn't work out very well, and they ended up selling it and losing $1 billion in the process. And so it was a disaster. It cost him his job. So that gives you kind of the extremes, the winner and loser aspects of that. The third one is buying back stock, and here at least you know what you have. You're just buying a bigger piece of the pie, so to speak. So the shareholder who's left has a bigger share of the earnings as a shareholder. So those are the 5 basic options. Again, put money back in the business, acquisitions, purchase stock, their own stock, pay a dividend, or sit on it through reducing debt or raising cash.
Okay, I hope this video helps you to look at the way I'm looking at this whole acquisition. And thank you very much, and hope you enjoyed this video. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.